One of the things we've seen as part of maybe the tariff discussion, the value of the US dollar has decreased, which is a little bit more advantageous on the global stage when it looks at US export potential. So in the face of some of these tariffs, maybe a little bit of a positive, tidbit there on the trade front. How much of the US dollar adjustment do you think is actually, or how meaningful do you think this is when you're looking at the general economic picture and where US ag goods sit?
So, yes, we did see the dollar finally break lower. And I say finally, it didn't have to break lower. It did break lower. It was kind of, the combination of weaker economic data, rising jobless claims, newly imposed tariffs on trading partners, like all that kind of helped the dollar weaken. But it's really our dollar value relative to some of the major competitors around the world. So when we look at a major buyer, obviously China buys a lot of ag products from the globe, not just the US. But we saw their dollar, or we saw the dollar weaken relative to theirs. So that kind of provided, a little bit of an incentive for them to buy more product. Two of our biggest competitors, both Mexico and Brazil, saw their currencies increase relative to ours. And so they've been relatively cheap. Again, they compete. And when your currency is cheap relative to somebody else's, it makes your product that much more attractive to buy. And so one of the challenges we've had is the Brazilian soybeans, especially. We just continue to see them grow more and more soybeans because their currency has been favoring soybean expansion. And the reason it's been favoring soybean expansion is because they've been able to sell it in the global market at a relatively cheap rate. So